any other kind of an insurance broker, any other kind of a broker, you are not limited to just what you have in your portfolio, to like a bank would. You can actually go out there and shop the various, you might shop,
shop
couple
for the consumer.
Dozen places.
Exactly.
Now, what I like and what has seemed to prove prudent is if you were not aware of this and you were out there, you might stop at the First National Bank, and then you might go to ABC Bank, and you might be shopping loans, and every time you go into a bank, they're going to require you to pull credit. They're going to pull your credit. And it may or may not ding your credit history when you're doing that. When you go to a person like Carolyn Wolf, who is a broker, she pulls your credit one time. How much does that cost to pull the credit?
It varies. It depends if it's a joint credit report or an individual or married couple, not married. But it can get up to about $90, but as little as $20.
Okay. So you pull the credit once. The important thing is you pull it once, and then you shop the various banks, the various private lenders, the secondary market with that one credit report.
Correct.
So you don't have to keep filling out credit reports. So that's one of the major reasons you want a broker. The other reason is a lot of times the brokers I've found have money available to them that is not readily available to a bank. It might be, I always call it's the backdoor policies, where it's more like wholesale money. You can go in and get things at sometimes a reduced rate because you're a broker and you're going in a different door to that same bank. So you might walk in the front door as an individual to the First National Bank and get turned down, but you go into Carolyn and she might be able to see a way to get that loan at even a better rate coming in the back door of the First National Bank. It sounds a little strange, but it's very interesting to know that you have a broker out there finding the best situation.
Correct.
So we've covered that. You want a broker. And Carolyn Wolf with Certified Mortgage Planners. Do you think we should just go ahead and give out your MLS number again? What the heck?
That number is 268-538. Thanks, Jean.
That's kind of like your license number, isn't it?
It is, yeah.
That's so you
the
can
National
officially
Mortgage
talk.
Licensing System.
Right.
License number.
They won't let you talk unless you give out that number.
Right.
And that's Carolyn Wolf. And give out your phone number and email one more time, because I know people are going to want to write this down as we get into some more information.
Okay. My phone number is area code 321-795-9103. And my email is Carolyn, CAROLYN, at FloridaLendingPro.com.
The next subject we're going to talk about is the importance of being pre-qualified or pre-approved and the difference between those two scenarios. So tell us the definition, Carolyn, for pre-qualified and pre-approved. They sound like they might be the same thing, but they're different.
They are different. That's a great question, Jean. Okay, so when somebody's getting pre-qualified, we are basically, the majority of people, and everybody does do it a little bit differently, but what we do is we take a completed loan application, we run credit, and we also do have an interview. It usually lasts about a half an hour asking certain questions. And then once we pull the credit and we cross-check the numbers based on what the client is telling us, we can issue what's called a pre-qualification, and we can run it through our automated underwriting system based on the information given verbally, and it will give us an approval or not. With a pre-approved, you have provided pretty much all of your documentation as well. So your tax returns, your pay stubs, your W-2s, your bank statements, the credit report, and we have sent it to an underwriter to actually sign off on that particular loan. Most of the time, we're going to do the pre-approvals when maybe we're right there on that edge, and we want to make darn sure they're approved before they go in and find their dream home. So we want to, make absolutely sure that they're good to go.
So pre-qualifying is you can do that on the phone. They tell you various numbers, how much they make, what their debt is, and you pretty well do that on the phone.
Correct.
The pre-approval is when they actually bring all the documentation that's going to be required anyway at some point in time, And they bring all that to you. It goes to the underwriters, and they said, yes, you're pre-approved. You're ready to go for a $200,000 loan or whatever it is.
Correct.
So how long after they pre-approve, how long does that last? Is that only like 30 days or 60 days?
They're actually good for 90 days.
Okay.
And generally what happens at that point, what we do is we just have a conversation to find out if anything's changed. Has your income changed? Has any of your assets changed dramatically? If not, the only thing we're going to do is we're going to repull the credit, which does not affect the credit score. It actually gets recasted after 90 days.
That sounds great. Mm-hmm. And I wanted to make sure that people understood that, because we want to tell you how to go about being pre-qualified or pre-approved, because here's a scenario that happened just this weekend, and someone lost out on their dream home because they couldn't compete with the other offers. And to give you an example, we had a big open house, and we had about, I couldn't even tell you how many, 35 to 40 people came through in 2 days. And it was listed on Friday morning, and we already had like 8 offers by last night. And the real estate agents that brought in the offers, some know how to do this properly because they've been in the business a long time. So that's another plug for finding a professional.
Like Jean.
Well, thank you, Carolyn. But finding a professional that knows how to do this properly, because it's like anything else. If you go into something unprepared, then you may or may not be in the winning seat. So here's what happened. We had some people were bidding, and it actually their offers became higher and higher over the ask price for the home, the price listed on the home. So some of them were up to $10,000 over the ask. And normally you would think, oh, I'd take the highest priced one. But because that was a loan, and it was going to be a loan, and they did not have their pre-approval letter, they was a little sketchy on their pre-qualified. And we had another one that was less than $10,000 over, but it was cash. So the person said, why, I don't even know if this person's going to be able to get a loan. And even though it was tempting to have a higher price, the cash one won out. So you have to be prepared, because you're going in there as almost like a package. You're going in there as a buyer with a pre-qualified and everything, because your house, when you get a loan, your house has to get qualified as well as you. So you have to be, have to know about appraisals and so forth. And we're going to talk a lot about that in future shows. But bottom line is, you have to go in there looking your best on paper.
Correct.
So if it's between you and someone else and you look like you're ready to go, there's not going to be any questionable things about your pre-approval or pre-qualified. That sometimes can trump cash, and cash usually is the power player. But if you've got your right paperwork, you can take those homes that you got the best offer in there. So that's one of the reasons why we want to talk about having that pre-qualified or pre-approval letter. So the difference is when someone calls you, we've talked about this again on other shows, we always recommend, before you go out there and look at homes with a real estate agent or even on your own, you want to talk to someone like Carolyn so that you know exactly what you're going to be able to afford and what you're going to be able to get through on a contract, because your contracts are all going to be stipulant on getting a mortgage. And if you can't get one and you've taken that off the market, that's not a good thing for anyone involved. So let's talk about when someone calls you, you kind of recommend that they call you 3 or 6 months out before they really are ready to shop.
Absolutely.
And some of the reasons for that, Carolyn, tell us some of the reasons why they want to even go that far out before they start looking at homes.
Okay. One of the biggest reasons that it's a great idea is checking that credit, because sometimes we don't always know how well our credit is, or there could be something that has popped up that's not theirs that we need to take the time to clear up. And it's not always going to show on those credit karmas or the consumer credit reports, because they're much different than an actual mortgage credit report, because ours is more detailed. Things will come in that not necessarily would attach on a consumer's credit report. So that's the big one. Another one is about seasoning for cash. Sometimes people don't realize how much they're going to need for closing, so that gives them time to save up more for the down payment. So that's another big reason to do that. And just so that they have a really good idea and know comfortably what they can afford, and then they can start kind of doing their due diligence and looking around in the area.
Let's talk about that. So for an example, on that credit report, that is very interesting that the credit report that you pull is different than on Credit Karma or one of the online free reports.
Right.
So they go into a little bit more depth. And in today's age, I hate to say this, but it's the truth. You don't know, maybe your identity's been stolen.
Right.
And you need to know that. And you might not even know that unless somebody pulls a real in-depth credit report. Right. And you're going, wait a minute, I don't have those credit cards.
Right.
I don't have this, because that's going to make a difference on whether you qualify for a loan if you've got all these credit cards that aren't yours.
Exactly.
And it gives you time to get yourself back into the right position for your own credit.
Correct.
The seasoning, we always laugh about that. I always like that, seasoning your cash. Almost sounds like a cooking show, doesn't it? But seasoning cash, explain how that word season, what that actually means.
Well, one of the things that we do as a lender, and all lenders do it, is we get 2 months of bank statements prior to once you start doing the loan application. Within those 2 months, we are going to look for any large deposits that cannot be accounted for. And the three main reasons is, well, the U.S. Patriot Act, because we're tied to that. So they're looking for any kind of funny money. And then the other...
funny money. Seasoned and funny money.
Yeah.
We love it. Okay.
The other big one is that you cannot borrow money for your down payment. So a lot of times people think I can do a cash advance on my credit card, but you can't, because it's really not your money. Credit card revolving credit is not your money. If you borrowed against your own retirement, that's a different story. And that's another great reason why we at Certified Mortgage recommend that we talk to them 3 to 6 months ahead of time, because we don't just look at the mortgage. We're going to look at their whole financial picture. And sometimes we might look at the credit report and advise them to maybe pay down a higher interest credit card versus using that towards their down payment. And or if somebody was thinking of doing, withdrawing their whole 401k, that's not something that we always recommend. So we might, kind of advise them based on looking at the whole picture for them.
Well, going back to the seasoned money, that just to tell it in a different way, that means that you want to see that money's been there and is traceable to something. So if all of a sudden you're looking at bank statements and you see that, gosh, it was $20,000 deposited in here, and they go, yes, that's what we're going to use for our down payment, you've got to know, well, where did that come from? Because,
correct.
They're looking. The federal government is looking for funny money. Are they drug dealers? What are they doing here?
Exactly.
So you've got to say, and they say, "Well, I sold a boat." Okay, so you get the receipt, you see that.
Exactly.
But if they're just about ready to write a contract, and all of a sudden they're going for a mortgage, and that there's that money, and you haven't had time to see it in a bank statement for 2 or even maybe longer, that might hold up the entire closing or the whole contract, really, until whether it's your company or any company, they're going to want to see, hey, where did you get the money to put down?
Correct.
And if it's a gift, that's a different story.
Right.
And that may or may not be acceptable depending on the type of loan.
Right.
But they need to watch us. It's
it's
a big brother.
Yes, a gift is perfectly okay, but again, you have to start to trail that. So now you need a gift letter, and then you have to get proof from the donor's account. So just like you were saying, if you're waiting kind of for the last minute, and now we have to deal with trailing money, it can add a couple extra days.
Exactly. A lot of people just don't know that, and those are those little things. Now, also, just to kind of give you a little bit more credit here, Carolyn, as far as how you position your clients on the phone. If I go into, again, the First National Bank and they want to take my application and I take it and they go, you're denied, they may or may not want to educate me on the reasons why I was denied. You're going to up front find out from people a little bit more about what their plans are. You're going to ask questions like perhaps the car loan. That's always our big ticket, as that car loan, because if they do have a car loan and give us the stipulations. It's what, 10 months?
Less than 10 months.
10 months. So I have a car loan and it's a year. I have a year on it. That's going to count against me as far as debt ratio.
Correct.
And maybe or maybe not that banker's going to tell you that, because they're not there to help you get the loan. They're only there to have you fit into their, square peg and square hole type of thing.
Right.
So one of the questions you're going to be asking them is if you have a car loan and they say yes, you're going to say, well, how long do you have left on it?
Exactly.
So for an example, if I only had a year or even 14 months or 15 months, whatever I could afford to buy down, and you said, gosh, if you can get that loan down to 10 months or less, it doesn't count.
Correct.
So I might go ahead and pay 3, 4, 5 months of my my car loan payment,
right.
So it doesn't count for my debt ratio.
Right, and that's another great example of why you should do it well in advance.
Exactly, because you wouldn't know that.
Right,
Now,
and then it would give us time to reflect once you pay it down.
Oh, reflect? Do we get
yes,
to reflect?
we need time.
We need time to reflect.
If you do a large portion to pay it down, then what we would do is do a credit refresh to show that now the balance is less than 10 months remaining, so we don't have to include it in a debt ratio.
And that's just one of those little tips. Little tricks. The other little, they're not really tricks, but they're
you're
the
true.
things.
Right.
They're what that need to be done, but people don't know about them. Tell us about the 30% on credit cards.
Okay, so a lot of times
I love this one.
I know, it's kind of, I really wish they would tell us as consumers. So what happens with credit scores, and this can make a really big difference, is say, for example, you have a credit limit of $1,000 on your credit card. So you think you're fine. You can go up to and spend up to $1,000, which you can. However, when we exceed 30% of our allowable limit on our credit, our revolving credit, it affects our credit score. It lowers it. So, for example, if you do have $1,000 credit limit and you don't want to have a balance no more than $300 on that particular revolving card. So a lot of times, too, what we can do is try to bump up the credit score if it's going to help put us into a different interest rate bracket or something like that by paying down credit cards just below the 30% instead of entirely paying them off and down. And you don't want to pay off old credit cards.
Interesting. But back to your $1,000. If I hear this all the time, I max it out every month, but then I pay it off. That's still not necessarily good to have a max it and pay it off. Is it or isn't it?
Well, not if they're maxing it. But a lot of times I do the same thing. You use it and then you pay it off at the end of the month. But if you max it, it just depends on the snapshot in time on when that particular creditor reports to the credit bureau, because we all have to report once every 30 days. So if it's your credit card, it just depends what your balance was when that
they
credit.
Show that.
Exactly.
So in the case of, we've just said, if you had let's just say $1,000 maximum on your credit card, and you have you have $300 is all you're going to go up, because that's what we've said. You don't want to go over 30%.
Right.
But you somehow need $1,000 all the time. You're floating different things, or you need it. You're better off getting maybe 3 loans, $3,000 credit cards, and only have them at $300 each,
right,
as opposed to putting $900 or $1,000 on one.
Right. Or you could check with your credit card company to see if they can increase your limit. That's another way to do it too. So if you have a good payment history, most of the time credit card companies are going to want to increase your limit, because
and people forget that. You can call them and ask them to lower your interest rates and increase your credit.
Yeah, your limit.
Your limit.
Yep. Absolutely.
So those are the kind of things. So what if I'm calling you now? I'm interested. I've been listening to the show, and I say, okay, I'm going to call Carolyn at 321. I might as well say the number. Is that the primary one? It says
795-9103.
795-9103. I'm calling Carolyn, and I'm saying, Carolyn, I'm really kind of thinking about a house. What would be some of the questions you're going to ask me?
Okay, great question, Jean.
Or you're going to need from me?
Typically, what I like to do is have an interview of about 30 minutes or so, just to kind of get to know the scenario, find out what the client is looking for. Are they a first-time home buyer? Are they a veteran? What kind of assets do they have? what were they thinking as far as the amount of money that they wanted to put down or put into the whole transaction. And so not necessarily just the down payment, because it could include your closing costs. And also, one of the things that we really like to go over is the comfort level. What do you want as a mortgage payment? So your total household payment, what's your comfort level? And that way we can kind of backtrack it and figure out this would be your ideal purchase price based on some of those scenarios. And we're also going to find out about credit. We want to know, kind of what their history's been with credit. And as far as their situation, have they ever had a bankruptcy? Have they ever had a short sale? What type of income they have? How are you paid? How long have you been there?
Future income.
Yeah, exactly. But we put it all together so that we can look at numbers and talk together and work together and come up with how much you're going to need for down payment, what type of product's going to fit you best, and how much of a loan you can afford.
And all those ratios, debt ratios, are different based on conventional.
Correct.
The FHA, VA, also how much money you're putting down. Mm-hmm. So all of that takes into consideration. But one nice thing is you can talk, especially if they're a first-time home buyer, because although the veteran home buyers also make this mistake, they get so excited. Maybe they just got married or they just moved here and they're buying furniture and they're buying cars and all this stuff. So you can talk to them a little ahead of time and say, don't buy anything right now on time until you find your house.
Exactly.
Because once you have the mortgage, they don't check up on you every week to find out if you bought a car. But if ahead of time, they're going to see that, and it might throw your whole debt ratio off.
Right. And that's a good point, too, just to let people know for sure out there is, even though we get you qualified in the beginning and you're now going through the process and you get approved, don't do any new purchases until you are in the home, because we are always going to do a cross-check right at the very end.
Yeah, right there. The very
and it
end
has
happened.
Stopped some closings.
Unfortunately, people get laid off right in the 30 or 45 days until closing, and they're going to check the day or two before closing, and you don't have a job. Or the new car. and that's when we want to kind of reprimand them, but we can't. We've got just a couple minutes left, but what are some of the qualifiers? What can people use as showing for income?
I would say probably the best tool for people to play around with is if you take your total gross income. So this is before taxes, before your 401k comes out. So your gross salary, and you times that by 44%. And you minus out any of your revolving debts, your car loan debts, your installment debts, any other property you might have, as well as if you do pay alimony or child support, and whatever's left, that would be your mortgage payment. And most of the time, it's going to be quite a bit more than what that consumer is more comfortable with paying, but that is the best way to run your numbers.
Well, before we run out of time, I want you to put in your phone number, or tell everyone your phone number and contact information again. That's Carolyn Wolf with Certified Mortgage Planners.
Okay, thank you, Jean. And my phone number is 321-795-9103. And my email is carolyn@floridalendingpro.com. And I did want to say, too, I can't stress enough how important it is to work with a great agent like Jean Newell here Carolyn, from Waterview Realty.
Here's your $10 for saying that.
It's very important. It's a huge factor in this whole transaction.
Well, what we usually talk about, too, when Jonathan is here, my broker, Jonathan Lack, he's also a real estate attorney with Lack & Lack Chartered in Indianapolis. He also owns Waterview Title Services and the broker at Waterview Realty. All three hats he wears, and we try to make sure we keep everybody on the straight and narrow and help solve those problems. So if you have any questions for me, you can always reach me at Waterview Realty, and you can also text or call me at 321-480-1574, or visit our website at www.yourhometownsolutions.com. That's our radio website. And we're here to help you find that dream home and make your problem solving. We're going to help you with problem solving your new home, refinancing, all kinds of things. We're here to, as I said, discussing everything from foreclosures to Feng Shui. Carolyn, it was a pleasure to have you in the studios again. We still didn't touch on a lot of the things we were going to cover. It's going to be another show. But just tune in next week on Monday at 1:05, and we'll be talking about other things that concern your family, finance, home, and garage. Thank you, Carolyn.
Thank you, Jean.
Bye, everyone.